Let's now move on to the external sources of finance, which include loan capital, share capital, and stock market flotation. Loan capital refers to the money that a business borrows from a bank or another financial institution. When a business sources finance via loan capital, they are given a lump sum of money which is expected to be repaid over a set period of time. This allows a business to make a clear judgment about the affordability of the monthly repayments and how the loan will impact its monthly cash flow before deciding whether to accept the loan. But loan capital can be an expensive source of finance due to the interest that's added on to the repayments, and a business might not even qualify for the amount that they need to borrow. In fact, in some cases, banks may actually ask for collateral for the loan, just in case the business doesn't pay it back on time, which decreases the risk of lending for the bank. For example, a loan may be secured against the asset that the business is actually borrowing the money for, and if the business fails to repay the loan, the bank can seize the asset. In contrast to loan capital, share capital is when finance is raised by selling a percentage of the business by offering shares to potential investors. The benefit of raising finance through share capital is that the business doesn't have to repay any of the money, nor is it charged any interest or additional fees. Also, the business is in complete control over who it offers shares to and can turn down offers from anyone it doesn't want involved in the business. But only limited companies can source finance through share capital. And once a business receives money from selling shares, control of the business gets diluted, as these new shareholders are now due a share of the business's future profits, which are often paid in dividends. As a limited company grows, it can also source finance via stock market flotation by becoming a public limited company and offering shares to the general public via a stock exchange. This can provide a business with the opportunity to raise large amounts of money, and the best thing about it is they don't have to repay any of it and they're not charged any additional fees or interest. But this is one of the most complicated sources of finance, and over time, the owner risks losing complete control of the business as anybody can buy shares.